thank you so much. First off, everyone who made the time to come out on a beautiful sunny day here in Vancouver. Probably had a lot of other options here as the sun doesn't come out much, but appreciate you taking your time. Everyone that's in the chat room as well, really appreciate you guys also taking time out on a Saturday to join us. As we get started here, really excited for everybody here to learn from people over 3 different disciplines. We have mortgage specialists. Sina is going to start it off on the financial planning sort of thing, and I'll be finishing off with real estate. But I think what we all agree on is that it's so important, no matter where you're wanting to be, is to make sure that you are paired up with a team of financial portfolio professionals to understand where you want to go and where you need to be. Without a roadmap, you can't get there, and that's why we're doing this. So I'm not going to, you guys have been patient in the chat room. We're going to start right now. Also, put your questions in the chat throughout. If we say something or skip it, make sure that you put it so the speaker at the time can address it in real time. We want to be able to do that for those who are at home. And yeah, we'll kick it off here with Sina. So thanks so much. And Nick will follow, and then I'll finish up.
Amazing. Thank you, Kyle. Hey, everyone. It's lovely to have you guys join us on a Saturday. On a lovely Saturday. We're going to go through a lot of interesting information today. I'm going to kick it off. The main topic of today is going to be around buying your first house. Now, of course, that's a big step in your financial life, specifically in a country like Canada, specifically in a city like Vancouver. And that's probably one of the things that everyone has on their mind, that they want to get done preferably sooner rather than later. I have to pay attention to let people in on Zoom as well. Now, I have a little bit of information about me here. I'm not going to go through it. I'm sure you guys can take a look at it yourself. But as far as going through the information with regards to purchasing your first house, what I'm going to do is I'm going to share my screen, and I'm going to take you guys through some basics and then some of the things that you have to pay attention to. Okay? So guys, one of the things that I always teach my clients is when you're talking about the proper financial discipline and making decisions properly, we always go through something that we call the investment foundation. Typically, the things that we have the least amount of control over become the most important things that we have to take care of within our financial plan. See, of course, asset accumulation, investing, buying a house, planning for retirement, all of that is a huge part. But before we start having that conversation, there's a couple of foundational pieces that we have to take care of. See, the number one piece of a financial plan that we have to take care of is the proper protection. And that's protecting my income, protecting my assets, because realistically, nothing else really matters if tomorrow something out of control happens. If tomorrow I lose my income due to whatever reason, or if an accident happens or a health issue happens, all of the other plans that I've created for myself, all of a sudden they start to lose meaning. So that becomes the foundational piece. Now, of course, it has to be done within reason with the right strategy. Then we got to make sure any bad debt is eliminated. Debts that's accruing interest, we got to get rid of that as soon as possible. Then we got to make sure we have enough money for emergency purposes, so that if something goes wrong with our income for a period of 4, 5, 6 months, we're not having to touch our assets and lose our assets or maybe go into debt, and we can have ourselves a little bit of a room of an emergency money to pay attention to. And once all of this is taken care of, now everything can be focused on accumulating assets, including buying your first house. So that's the financial discipline that I always try to teach my clients. One thing that I think is pretty interesting when it comes down to buying your first house, specifically with the context of planning in order to be able to put the down payment to do it, is paying attention to the tools that exist in this country to be able to do that. So what I'm going to do is I'm going to talk about taxes a little bit with you guys, and how there are a lot of tax advantages and benefits for individuals to be able to plan and prepare to buy their first house. So first thing I want to review with you guys is this. This chart is pretty interesting. There's a bunch of dollar numbers that goes from 0 all the way up to 227,000 plus, and this is representing the annual income of an individual who lives in BC. And there's a bunch of percentages that goes from 0 all the way up to 53.5, and this is representing the tax bracket based on the incomes on the other side. And all of these numbers that you see in the middle is basically showing you the difference between one annual income and the next. So from 43,000 to 50,200, the difference is 7,200. It's broken down in the middle. Now, let's use a thought experiment. Let's say Kyle lives in BC and he makes $90,000 every year. That's his income, just as an example. That means Kyle's income is going to be somewhere between 86 and 98,000. So that places Kyle in the 31% tax bracket. Now, looking at this at first, it seems like Kyle has to pay 31% of his entire income in taxes. However, the tax system we deal with in this country is what we call a progressive tax system. That means as you and I make more money, it's only the upper pieces of our annual income that is subject to more tax. The lower pieces are always taxed at their own rate. Here's what that actually means. When it comes down to calculating your taxes, here's what the CRA does. They actually divide the annual income into a couple of different pieces. And each piece is going to get taxed at its own rate. The first piece of everyone's income in British Columbia is approximately the first $11,300 that they earn, 0% tax. The second piece is the $3,100 above that gets their total annual income to $14,400. This $3,100, 5% of it needs to be taxed. The third piece is the $28,600 above that gets the total to $43,000, and this $28,000, 20% of it needs to be taxed. So as we make more money, the upper pieces are getting taxed more. Here's what that actually means. The only piece of Kyle's income that's getting taxed 31% is the sixth piece, which is $3,900. The rest of his income is progressively getting taxed less. And this creates two different tax ideas. The highest bracket that Kyle would sit in, we call it Kyle's marginal tax rate. However, after all of these calculations are done, we will realize what Kyle's average tax rate will be. So what ends up happening is Kyle is going to pay an average amount of taxes on his entire income. And that's how the calculation is done. Now, here's why that's important within the context of buying your first house. So let's say Kyle has a plan to buy a house 5 years from now, just as an example. And let's say Kyle and his wife, they both earn $90,000 every year. So in the Canadian banking system, we have a couple of registered investment accounts to pay attention to when it comes down to purchasing your first house. So you guys might have heard of some of these accounts before. The TFSA, the RRSP, the FHSA, which is a new one that was introduced this year. So I'm going to start by talking about the TFSA before I kind of like go through the full picture. The TFSA is an account that was designed in 2009 that allows me to put my after-tax money, which I like to call my clean money, the money that I've already paid taxes on. Inside this account, it allows me to select any investment vehicles that I want that is provided through a financial institution and achieve growth. And this growth is going to happen tax sheltered, meaning I don't need to worry about paying taxes on it as the money grows. And ultimately, at the end, it allows me to take all of my money out completely tax-free as well. So it allows me to actually grow my after-tax money in a tax-free way and access it at the end in a tax-free way as well. I have the limits for each individual's TFSA based on the year that they got their social insurance number or they actually turned 18 years old here as well. And of course, there's a lot more details that we can go into it, but I just want to do a very quick review to talk about the big picture strategy. So the TFSA, very useful to invest, grow money tax-free, and have access to it at the end tax-free. The RRSP is also very useful because as I contribute money inside my RRSP, as the money is going in, my contributions are deductible from my income. So if Kyle all of a sudden decides to put $10,000 in his RRSP, at the end of the year, his income will come down by $10,000 and then his taxes will get calculated. So he ends up paying less taxes, right? Now we're going to talk about exactly how that happens a little bit as well. And again, Kyle gets to decide whatever sort of investment vehicle he wants to put inside his RSP and grow his money without having to worry about taxes. But ultimately, at the end, when he's taking his money out, he has to pay attention to the taxes, right? He has to pay taxes at the end when he's taking his money out. And we're going to talk about how that relates to buying your first house a little bit later as well. So money coming out of the RSP will get added to Kyle's income. Now, there's a little bit more detail. I'm going to go through it later. With the first home savings account, which is the new account that we have access to this year, with the new first home savings account, here's what's going to happen. You get to actually contribute into it, and your contributions, just like the RRSP, are going to be tax deductible, meaning it brings your income down and you save on your taxes. Ultimately, you get to grow your money through your investment vehicles in a tax-free manner as well. And if you decide to take your money out to buy your first house, you actually can take everything out completely tax-free as well. So unlike the RRSP, you can take money out tax-free to put towards your first house. So these are a little bit of detail around these different investment accounts, but I'm going to talk about a little bit of a strategy that we can use for Kyle in this scenario. Okay. So Kyle makes $90,000. His first home savings account limit every year is going to be $8,000. So that means he can put up to $8,000 of his money inside the first home savings account every single year, and his maximum lifetime contribution is $40,000. Now, here's what Kyle decides to do. He decides to put $8,000 inside his first home savings account this year. What happens is Kyle's income all of a sudden will go from $90,000 down to $82,000. That means his taxable income was reduced by $8,000. And here's what happens. If Kyle is an employee and he's paying taxes off of his paychecks, the CRA doesn't know that Kyle is going to use the first home savings account. At the end of the year, when he does a meeting with his accountant, the accountant realizes, wait a minute, you reduced your income through the use of the first home savings account. So the income comes down and Kyle is going to receive some tax refunds. And the tax refunds are roughly, let's say, going to be around $2,000. It's probably a little bit different, but let's say it's $2,000 of tax refund that Kyle will receive just because he utilized this account. Now, guess what? Instead of spending the $2,000, here's what Kyle can do. Take this and put it inside your TFSA. And both your first home savings account and your TFSA could be invested. So now, all you did, Kyle, was you invested $8,000 inside your first home savings account. You got $2,000 of money back from the CRA, and with an $8,000 investment, you all of a sudden invested $10,000, right? And both of these accounts, the FHSA and the TFSA, can grow your money if you choose proper investments in a tax-free manner, and they allow you at the end to take money out tax-free. So now let's say Kyle does this for the next 5 years. So that's $40,000 of money that Kyle has put into the first home savings account, and that's $10,000 of tax refunds that he has received from the CRA that he was able to reinvest inside his TFSA. Now, if he does this properly, he would probably be able to grow this a little bit. Let's say the 40,000 will grow to be 45, just as, just for the sake of the conversation. And let's say the 10 would grow to be 12. So ultimately, at the end, all Kyle did was save $8,000 every year for 5 years. And that $40,000 turned into $57,000 that he could use to buy his first house. And if Kyle and his wife both go through the strategy, now 57,000 times 2 is actually 114,000. All they did was set aside $8,000 a year for 10 years, each of them, and now they have 114,000 that they can use for the down payment. To make things a little bit more interesting, the RRSP account also has something called the First Time Home Buyers Plan, which allows you to take out up to $35,000 out of your RRSP, completely tax-free, to help out with the down payment of your house. So the exact same strategy we talked about here, as far as putting money inside a tax-deductible account, reducing your income, the taxes coming back, you could use it within the RRSP as well, up to another $35,000. Again, there's a little bit of a detail that, of course, we can go through at a later time. But in general, my point is, and let me mention this before I forget as well, the home buyer's plan, unlike the first home savings account, when you take money out of your RRSP for the first time home buyer's plan, you have to put it back inside your RRSP for the next 15 years. So you give you 15 years to kind of return your money to your retirement account, and then ultimately at the end, when you take it out, you have to pay the taxes. So you basically are borrowing from your retirement money in a tax-free, interest-free way, but you have to return it in there. But the first home savings account allows you to take your money out tax-free, and you don't need to return it. So these are the tools that if you pay attention to, it is actually going to expedite your ability to save the down payment in order to buy your first house a lot. And here's one thing that I want you to pay attention to. And I'm going to pass it off, I believe, to Kyle next. The thing that you have to pay attention to is this. See, we typically buy our first house with our clean money. Here's what that means. We go to work, we make money, we pay the taxes, and whatever is left, we save, and then ultimately, we buy our first house. Through the proper utilization of these accounts and the strategies that we briefly mentioned, you can actually purchase your first house with your dirty money. Meaning, you can go to work, make money, you don't need to pay taxes on it, up to, of course, a certain limit. So you can save the tax-free money that you earned from work to put towards the down payment. If you already pay taxes off of your paychecks, you're going to get those taxes back in form of a refund. So it actually increases your purchasing power for your down payment by around 20 to 40% of money that otherwise you would have to pay in taxes. But now, because you were smart with the utilization of these accounts, you can actually use your money in a dirty way or in a basically tax-free way in order to put it towards your down payment. Did that make sense? Yes? Okay. So do we want to take questions, guys, now, or do you want to leave the questions for the end? Nick, should we take questions or should we leave the questions for the end, guys? Okay. Is there any questions, guys? You can put it in. Go ahead.
Somebody gets their SIN number, say December 20th of 2023. They get a TFSA of 6,500.
So that's a good question. So the question is, if someone gets their social insurance number in December of 2023, what is their TFSA limit going to be? So it doesn't matter at what month of the year the SIN number is activated, right? Even if it's December 31st of a particular year, that individual would basically start their TFSA contribution limit from that year. So if they got their first SIN number in Canada in December of 2023, their TFSA limit is going to be 6,500 this year, and as soon as January comes around, it's going to increase to 13,500.
Okay, so in my example, within the first 10 days or last 10 days of December, they can just quickly go up to 6,000.
Yeah, even if they don't and they decide to put money in the TFSA next year, it will get accumulated anyways, right? So yes, the limit starts in December of 2023. And of course, the TFSA limit increases every year as well, and they're going to announce what the increase is. And for the next year, they've already announced that it's going to be $7,000. Of course, guys, the way I do my thing is I share my screen, I go over information visually. I have a full process of kind of like going through all of this information step by step in a more detailed, patient way. And of course, if that's something that you guys are interested in learning about, you can directly contact me, and my contact information is going to be there at the end. But I'm going to pass it off to Nick. Nick, why don't you come on down and tell us a little bit about mortgages so we can actually learn that aspect of it as well. All right, there you are.
Hello, everyone. Hello. Okay, I'm just gonna, yeah, everybody can hear me, I assume. So, yeah, I'm a mortgage broker. I run Ultras Mortgage Solutions. I'm a partner in this business. Myself and my wife, we've started it about 6 years ago. And just so you know, if you don't know the biggest difference between working with a mortgage broker versus working with a bank, we have access to 30 plus different lenders, right? Including Scotiabank, TD Bank, HSBC, Coast Capital, and 30 other lenders in Canada. And so this allows us to find a very, niche products for our clients depending on their needs. On top of that, both myself and my wife, we come from underwriting background. So before becoming a broker, my wife was actually managing mortgage fund. So we understand the back end of lending very well. We understand how lending decisions are made. Our senior underwriter, Joel, also, he's been an underwriter for over 15 years, working for different credit unions and smaller lenders. So we're very proud of, having extensive underwriting experience. So if there's a way to do a particular mortgage, we will find that way, essentially. And now what we're also proud about is that we make sure that 100% of our clients who come to us, they walk away with a solution. And what I mean by a solution is that either they're going to get approved for the mortgage they want, or they're going to have a plan of exactly how to get and qualify for the place that they want. We have clients who, came to me 3 years ago. We would come up with a plan, say, hey, listen, you have to pay off your debts, whatever Sina was talking about is very important, because it's not the best time to buy for everyone. You need to be in the right, financial situation to afford a place. So you have to have a plan as well. Now, I encourage you to Google the name of our company and read what people say about working with us as well. We are an award-winning team. So yeah, do your due diligence. I want to talk about today is address first, elephant in the room, our rates, right? We all hear these talks on the news, rates, what's happening, rates are going up, nobody a lot of people are on the fence, and a lot of people are on the fence for good reasons. But let me ask you this, what happens with real estate prices when interest rates go up?
Goes down.
Exactly, right? So, and then a lot of people saying, hey, we're gonna wait until interest rates go down to buy, right? So, well, what happens when interest rates go down, right? Prices go up. So what I want to do is kind of compare with you, hey, what was happening when we had a situation about 2 years ago in 2022, when it was one of the hottest markets in Canada and the rates were low. So let's look at what was happening back then, right? And this is a real example of, there was a townhouse complex in Fraser Valley that at that point, the price for the townhouse was $980,000, right? The interest rates were very low. And there were lineups of people standing wanting to buy a place like this. There were multiple offers. People were just, hey, I don't need subjects. I don't need to look at the place. I don't even need to see it. I already bought it as soon as it appears on the MLS without any pictures, right? That's what legit was happening. So what did you need back then to buy that $980,000 townhouse? You needed at least $73,000 down payment. At that time, the 3-year fixed insured mortgage was 3.19%, and a monthly payment at that time would be $4,556. Okay, so let's move a year from that time, right? When there was crickets, not a lot of people wanted to buy. And let's look what happened with that townhouse complex, okay? So a year from that time, the prices in Fraser Valley, and it wasn't even the whole Fraser Valley declined by about 20% in the 1 year span, right? So the price at that point was $830,000, right? There was that particular complex, so about 15% decline. So you needed $15,000 less in down payment to purchase this similar place. The interest rates were about 2% higher. Beginning of this year. So the difference in the payments would be about $109 per month. So in 3 years, you would pay approximately $4,000 more than compared to if you bought it a year before, right? Before the market slowed down, before prices declined and the interest rates were low. Now, let's see what it translates to, okay? Also, some other numbers that are important to see. So your mortgage, on the other hand, if you bought a year before, would be $135,000 more, because buying beginning of this year means $135,000 less of a mortgage. On top of that, your insurance premium, in this particular scenario, because you're putting less than 20% down, you are obligated to get a default insurance in Canada, so your default insurance would be $5,400 less. On top of that, you don't spend as much on property transfer tax because the purchase price is lower, right? So in short, high rate and lower price, right, means that you need $18,000 less in cash to buy and $140,000 less in mortgage to borrow. Now, important to know is that we all need to understand that rates are temporary. They always go up and down, right? And what's going to happen in 3 years, both people who bought in 2022 and who bought in 2023, they will renew their mortgage at some point in a similar rate environment, right? So what that means, let's assume the interest rate is around 3.5%, whatever the interest rate it is, the person who bought later at a lower price point would have a payment of about $600 per month less, on top of a much lower debt load, right? So remember that when you have an opportunity to buy with advantage in equity, right, a lower price, but probably a higher rate. You need to run these calculations because a lot of the times taking equity advantage means a lot more. So now let's talk about, so that's a little bit kind of an update on the market and what's happening with rates. But what is the first step? You want to purchase a place, right? The first step of the buying process. The first step of the buying process would be you to get your pre-approval. And I'm not talking about those online calculators that banks have on their website. It's not enough to go and to be able to, you know, confidently purchase real estate. So what you want to have, right, is someone who's going to review your income documents up front, right? They're going to review your credit, right? And they're going to provide you a commitment to lend, right? Which also called pre-approval letter. So that's what's going to allow you to know exactly where you're at financially and how much money you can borrow, right? You can confidently make an offer on the place. And on top of that, you can also negotiate better terms. I've seen that two people would come in to buy a place, you know, and somebody is very confident in their financing, and they can get a lower price point than someone who needs a longer time to figure out their financing, because sellers want to be sure when they're selling the place. So what does pre-approval process look like, right? Generally speaking, with our team, we know, you know, what works best. We've helped hundreds of families, and the way it works, it goes like this. You have a discovery call. It takes about 10 minutes, so we know kind of what your situation is and what your goals are, right? After that, there is a document collection process. So we would ask you for documents, depending how organized you are, you know, it may take you some time to get them to us. After that, we would sit down and have a strategy call where we're going to dive into everything what I mentioned, like your budget, your max qualifying amount, your monthly payments, all of that, right? And then essentially your pre-approval is complete. That's when you want to go to the next stage. Right? So I want to quickly give you an overview of what are the most important things to know about the pre-approval and qualifying for a mortgage. One of the main things would be the down payment, right? The rule in Canada is that you only need as much as 5% down as long as you buy a place under 500, right? A lot of people don't see much of a benefit in this. In our area in Vancouver and Burnaby, it's harder to find places for that price point, right? And then another thing is, if you need buy anything over $1 million, you need at least 20%, right? So looking at the example here, if we look at the example of, let's say somebody wants to buy a $700,000 place, they would need a minimum of $45,000 for the down payment, right? Because the way it works is you need 5% on anything under 500 and then 10% on the amount between 500 and 1 million. All right? So that's when it comes to down payment. Another very important aspect would be how much income do I need, right? Because it's income, down payment, and credit essentially. A lot of people ask me, hey, how much income do I need? Well, income and down payment are kind of tied together. And depending on how much down payment you're putting, whether you're putting more than 20 or less than 20% can actually make a very big difference. So let's look at this example here. Okay, let's say somebody comes to me and they they're making $158,000 a year, right? So in that case, their maximum purchase price, if they only have 10% down, would be $700,000, right? So if you have 10% down, and you want to buy a place for $700,000, your income has to be at least $158,000. Now, if you have 20% down, meaning $140,000, you need approximately $38,000 less of an income. There are different factors that play with that, but this is just to show how big of a difference down payment can make, right? If you want, please take a screenshot or picture. Again, these numbers change depending on where the rates go, right? So these numbers fluctuate, but it just gives you a good idea of what the difference in down payment can make. Now, quick useful formulas as well. Oh, go ahead. I see somebody didn't have time. Take a picture. Perfect. Awesome. Yeah. Also, because some useful information here, I wanted to throw out some other quick, useful formulas to remember. It will cost you approximately today $550,000 to $580,000 per month for every $100,000 that you borrow. On top of that, every $700 payment per month on your credit bureau will limit your purchasing power by approximately $100,000, right? So if someone, let's say, that's why I'm saying, guys, whenever somebody, wants to buy a car and it's on their list, first do the pre-approval. Consider if buying a property is on your radar, don't just jump into and sign a new car lease or new car loan, because that can affect your future. And buying a car and qualifying for a car loan is easy. Qualifying for a mortgage, not that easy. So there's a lot more flexibility with car loans and leases. So on top of that, every $25,000 in income, that more applies if you have less than 20% of down payment, can get you about $100,000 in mortgage money, okay? So let's look at the example here. So who can actually buy something like this, right? It's a 2-bedroom condo in New West, 2009 built. So I've run some numbers. It's a very, typical situation. What I would see, right? A couple household income is about $155,000 per year. So wife's making 79, husband's making 76. Car loan, $450 per month, and average credit history, right? You don't have to, a lot of people say, hey, I need to have a perfect credit to qualify. No, you don't. Talk to a professional. We'll be able to determine that for you, right? Your credit doesn't have to be like, it needs to be good, but it doesn't have to be perfect. So here's a mortgage breakdown, right? Depending on what down payment you're putting, right, it will affect what your monthly payments are going to be, what your rate is going to be, and what is your overall mortgage load is going to be, right? So if you buy in this place, right, and you have 10% down, you're gonna end up with obviously a higher mortgage, and you will have to pay a default insurance, what I talked about earlier, if you put in less than 20% down. The rate, on the other hand, will always be lower on the mortgages with under 20% down, because you are getting default insurance, so it's less risk for the lender, right? It doesn't mean it's cheaper for you to get that type of mortgage, but the rate is going to look more attractive. So a lot of the times when you see those ads online and they say, oh, our rate is like, and they usually show their best rate, that would mean that assumes less than 20% down. So the monthly payment in this case will going to be approximately $3,800, right? So similar property, if you were to have 20% down, you're going to have a much lower mortgage, you're going to have a slightly higher rate, and your payment is also going to be about 20% lower in this scenario for a few reasons. Obviously, your mortgage is lower. Second of all, you can stretch your mortgage over 30 years, not over 25. Here you're limited with 25, so here you kind of can play around, have more flexibility around your cash flow. So and second thing is, how much cash would I need, right? In the first scenario with 10% down, right, there are expenses that you need to consider. Biggest expense would be property transfer tax, right? So in case you're buying with 10% down, you'll need about $80,000. If you buy with 20% down, you'll need about $150,000. So that is the difference. Now, why? Let's quickly talk about why people do that. Obviously, what this particular family would do if they were to buy with less than 20% down. They would take their $80,000 in savings, whatever they have, and they would buy an asset which is much larger than their saving that now they can control. That thankfully to our, how desirable the place is where we live, is going to appreciate with time, right? And hopefully if they decide to ever rent it out, that they decide to do it, also can produce dividends. So that's an asset that now they control. Obviously, with such a big leverage, there are other risks that Sina is hopefully will address as well. But in general, the way people make money is because of the compounding effect. Do you guys know what was a long-term average growth in BC, in Greater Vancouver area, with property appreciation? Any guesses? Anybody would want to guess? What do you? Yeah, it's between 5 and 6%. Very good. So between 5 and 6%. So let's assume that for the next 10 years, and again, this is in particular not a financial advice, I just want to show you how the numbers work, how do people get rich, why people buy investment properties, etc. So let's assume it's not going to do as well for the next 10 years. We're going to look at, half of that. So right now it's closer to 6. Let's say it appreciates 3% per year, right? So and again, it doesn't mean that it will appreciate every year, right? It just talks about the average appreciation. One year it can dip 5%, another year it can go 10. But let's assume average appreciation of 3%. So that means that on the year one, on average, your property would be worth 683. You bought it for 664, it will be worth 683 in 1 year, right? If you continue that trend, in 10 years, right, that place could be worth close to 900,000. And again, it doesn't mean that the real estate in particular is becoming that much more desirable. It also shows how much money, how much value the actual cash is losing, right? So that would be, the growth that would anticipate. And on top of that, the family like that, they also have forced saving in the form of paying down their mortgage with every payment that they make, right? So that's in 10 years by how much their net worth would be affected by, given, that the property appreciates and they also paying down their mortgage, okay? So essentially, yeah, that's kind of in a nutshell of what mortgage process look like, what payments look like. And again, similar to Sina, we do one-on-one approach, right? We always want to sit down with our clients, see where they are, do the full pre-approval, and then it's crystal clear for all of our clients kind of like how they can continue on with their property purchase journey. So thank you so much for your attention. Yeah, and if there are any questions, guys, by the way, maybe some questions you guys have, I'm happy to answer, for sure.
We were talking about the default insurance. I was wondering if somebody has a personal insurance, let's say on their life, is that something that they can tie to so they don't have to pay any more premiums?
For sure. So that's a very good question. And actually, I've seen it came up quite a few times. So the question is, just so I can repeat it for the audience here, if you have a insurance on the side, like a life insurance or critical illness, whatever, can you tie it with the default insurance that you need to take? The answer is no, because the insurance that you have is to protect you. Right? It's to protect your, whatever, if something happens to you, to your family member. Default insurance, unfortunately, it's not to protect you. It's to protect the lender, because they're lending you money, and there is such a small spread between the mortgage and the price of the property that if prices were to dip and you would default on your mortgage, they will lose money. Right? There's not enough of a spread. So that's why they want to see at least 20% spread. That's why after 20%, you don't have to pay default insurance, right? So it's to protect them in case you default and you have to get it. That's kind of how economy is running in Canada. Yes, absolutely.
When it comes to taking mortgage, let's say somebody doesn't have that much income, but they have a lot of cash on hand. So is the bank going to, for example, give them more mortgage because they are less risky because they already have a lot of net worth? Let's say somebody with, I don't know, $100,000, they can get $500,000 mortgage as an example. But if that person has $1 million in their bank account, can they get more mortgage?
So there are different options. I would say in this particular case, there are two scenarios that I'm seeing most of the times. So when people have a lot of cash on hand, there are high net worth programs that are available, right? You need to show some income, right, on the side. It's not like you can really go into that program and you have zero income, but let's say you have something like $25,000 income per year and you have, $2 million sitting in your bank account. As long as you put 35% down, whatever you have in your stocks, a lender will give you $1 to $1. So if you have like $1 million, so you put 35% down, and after that you have $1 million sitting in your investments, they will match that amount with a mortgage. So they'll give you $1 million mortgage, right? So that's called how high net worth programs work. So 35% down, and then they will match whatever cash you have. There's a minimum requirements for that cash, but it is possible.
But would the rates be different for an individual like this because it might be more risky?
Not for the bank. There is something that's called equity lending, where you go to funds, mortgage funds, and you borrow money. They don't care about your income. All they care about is down payment, but those rates would be higher, right? And sometimes people, usually sophisticated investors, builders, whatever, they would use those type of funds. So that's when, that's when the rate would be different. But in this case, if you qualifying with a bank, they would offer the same rate to high net worth program and to any other borrower. Please. Sorry.
I just wanted to extend on a question Brandy I had here. So in case like a high net worth client and they have a lot of liquid assets and they have them like as an example in mutual funds and investing, right? And they're generating income as off of their investments. Would that income be something that lenders take in consideration as their income?
In some cases, yes, some lenders would want to see some sort of outside of investment. So it's not like all in one pool, it depends. But there are programs for what you're mentioning as well. But what lender may require in that case, they may want to see some money locked in with that institution, like something like 12 months worth of payments. For example, HSBC have similar product, but they would want you to have like 12 to 24 months locked in one of their accounts worth of payments, essentially. So it's like, it depends. So please.
If you get a high ratio mortgage and you end up renting that property, would the cost of the default insurance be deductible on your taxes?
That's a good question. So the way it works is for the first year, right? When you bought a place, you cannot really rent it out, right? Because otherwise it would kind of defeat the whole thing of the buying without default insurance, based on what I know. But after that, as it is part of the expense, yes, 100% it would be deductible. Why? Because there's really no separation. When you borrow money from the lender, there is no separation. Oh, this is what I'm paying for default insurance. This is what I'm paying for the mortgage. The default insurance gets rolled into a mortgage, so it's just one amount. And then you get insured mortgage, but it's one balance, essentially, if that makes sense. But it would be a better question to an accountant to discuss tax strategy and stuff. But yeah.
What about the first year you mentioned?
The first year, again, that's something that you would also want to discuss with an accountant. You technically can only buy a primary residence, right? And if you buy in a place with less than 20% down payment, right? So what happens is, especially if you claim any first-time homebuyer incentives, etc., to qualify for it as a primary residence, you need to live there for at least 12 months, right? And then it can be whatever you want, right? But if you're claiming any sort of benefits as a first-time homebuyer, because you're buying a primary residence, that would have to just be considered when you're claiming your taxes and showing where you're living, etc. Yeah. For sure.
Is it a good idea to buy something that is like that will be complete in future?
Yeah.
And another thing is that 20%, so it can be divided on that, or it's something that I need to pay on those homes, investment homes.
So you're saying essentially you're wondering about if it's a good idea to buy a pre-construction, pre-sale property, and that has a particular deposit structure with up to 20%, right? I would say I've definitely seen people, making great investments with those type of properties, right? There are certain things that you need to consider, right? You need to still sit down with somebody, because a lot of people say, oh, listen, I'm just going to get into the contract. I don't care. I'll figure it out in 2 years. You need to have a plan, right? How are you going to qualify for a mortgage when you need to close on that contract, right? That's one thing to consider. Another thing to consider is that a lot of the times, lenders would lend you on the present value of the property, right? So if properties were to dip, but you sign the contract at a higher price, you would have to pay off the difference, right? So that's another thing to consider. But yes, generally speaking, I would say it's a good idea However, I don't encourage buying pre-sales if you're planning on flipping it. Like a lot of when people say, oh, I'm just going to buy it so I can sell it, they don't have any other kind of option. They just, oh, I'm just going to buy it and sell it before it completes. I've seen people get burnt in those type of situations. Yeah.
I think there's a question.
For sure, oh, yes. So let me address some questions here. How does being a business owner with a fluctuating income affect pre-qualification for a mortgage? Okay, so that's a great question. So there are a few options, right, for self-employed programs. Generally speaking, if you walk into the bank, right, they want to see, if you're self-employed, they want to see 2 year worth of income, and they would use the average of those 2 years. There are ways to, play around with that and, extend your most recent successful year and make it like multiplied by 2. There are ways to do that, but big banks are very black and white, right? So what a lot of people do as well if they're self-employed, and the problem is if they don't have enough income. So what I usually see happens, there is a timing issue. So somebody comes into me today and they say, hey, listen, I haven't made enough income for the last 2 years. I have a good cash flow, but I haven't claimed enough. Can I qualify for a mortgage? And then we sit down and say, hey, if you want to go to the bank, you need to claim 2 years more. So they have to wait 3 years before they can even buy something. So a lot of people are not okay with that. So there are mortgages for self-employed people that basically just focus on your cash flow. They are more expensive than the bank, right? Generally about 1 to 1.5%. Those type of lenders charge more than the bank on the interest. But these are very popular products for people who are self-employed, who don't really have consistency in how much income they claim for tax optimizations. Hopefully that answers the question. Yeah. Yeah. So could someone let in a person? Okay, sorry. Gotcha. All right.
I also had a question, not sure how relevant it is, but this is about FHSA account. If an individual has bought a pre-sale, are they eligible to open an FHSA account? Yeah,
I would say that if they bought a pre-sale, there are certain rules on how soon the property completes. Like I know that there's some with RSP because of the withdrawal. So that's something that I would look into, because how soon are you going to be using it, right? For the actual down payment, not for just like when you're putting it in the contract, but there is a room. So when you take money out, you need to put it into the purchase. For RSP, I know that you need to put it into the purchase by like November of each year would be the cutoff time for that to qualify. So that's something I can look into for you on a particular date, how soon you have to roll it into the purchase.
But then this question is more so about, can I open the account?
Yeah, I mean, opening account is, for sure. So essentially, you don't lose your first-time home buyer status if you sign a contract on the pre-sale. On top of that, a lot of people confuse that, but to be a first-time home buyer, it says you should have never owned the place where you lived. So if you lived and rented, and you bought a rental property, and I did verify it with lawyers and notaries, you never own the place where you live. So if you had a rental property on the side, and then you're buying a primary residence, you can still be a first-time home buyer. Yes, you can still be a first-time home buyer because you never claimed the place where you live. I mean, yeah, go ahead.
I think we have to look into it to reconfirm, but that sounds about right for the RSP home buyers plan.
Yes.
For the
FHSA, okay, maybe we'll look into that. Okay. So we'll to apply for loan pre-sale. Yes, so I was wondering if it is possible to apply for a loan for pre-sale, or it would work only for completion. Yes, there are programs, pre-sale programs, where like a particular time before the pre-construction, the lender can hold an approval for you for longer than usual. Usual approval would take about 120 days. There are some lenders who would hold the approval for 18 months to 36 months for a pre-sale, but they have a big premium on the rate for those products. So I'm happy to address that depending on your situation, Ali. Perfect. All right. Awesome. Thank you.
All right, so my name is, for those who don't know me, Kyle Mark. I am with eXp Realty in their luxury division. I've been a realtor for 7 years, and the reason why we put this together is this is something that's super personal to me. I started getting into real estate at a very young age, but had to have the mindset approach for that. And with anything, and especially in Vancouver, because it's quite a challenging market, you need to be able to have goals for yourself, because if you don't have a goal and a plan, you're not going to be able to make it in this market. You know, super, to be honest, right? It's competitive, it's expensive, and that's why we're doing this event. So for example, the building that we're in now, this didn't exist. Someone had to create that in their mind. So for anyone who's looking to purchase, especially in an area like Vancouver, you need to make that goal, whether it's a vision board, you write it in a journal. That's very, very important. And making sure that you can provide opportunities for yourself and you know where you're going. Those opportunities will be put in front of you if you have a goal, because you know what you want to achieve. And that's exactly how we met and put this night on. I met Sina here in the elevator lobby. One conversation turned into this mindset. Both of him and I have the similar mindset, so I'm very big on that, and it's really important, especially in a competitive marketplace, not just real estate, but your whole personal life. And that is why, for myself, I got into buying pre-sales in 2013. I wasn't making a lot of money, $30 an hour, but because I got in, I had a goal from when I was young. I was able to leverage and use equity, and now I own 3 properties that worth over $3 million using the bank's money. So this is why we're here together, to help you on that journey, to increase your net worth, get you into the market. So as we get going, you can see that QR code, scan it. My social contact information's on there if you like. So as we get into some of the home buying process, show of hands, who's in the market right now, currently owns a home?
Currently owned?
Yeah, currently owns. And who's in here just to learn, wanting to get into the market? Yeah, exactly, right? So this is the perfect place to be, and that's why you're here, right? The 99% of people aren't showing up to things like this, and they're not going to get into the marketplace. So great on you guys, whether you're on Zoom or in person, being able to be here. So the beginning with your home journey, it's actually about a 16-step step-by-step process to get into the marketplace. Okay, so the first step is obviously doing some due diligence, whether it's on Google, referral, things of that nature, to make sure that you pair yourself with a realtor. There's over 15,000 agents in the Board of Greater Vancouver. So your mom, your uncle, your best friend may not be the best choice for you. Same with brokers, financial planners. There's so many, but there's only a small number that actually do the bulk of the work. So it's really important to make sure that you pair yourself and they understand where you're going. From there, making sure that you understand where the process is, your finances, things of that nature. Get in touch with a mortgage specialist such as Nick to make sure that you know exactly where you're going to go. If you have, depending on how much you make, the debt that you carry, it may be advantageous to take a pause of 6 months to a year to pay off your debts, so that you can get more lending, especially where the rates are at currently right now. It's super, super expensive to get money. So anything that you can chip off on your debt is very, very important. Once you get into that step, I'm not saying that you need to have a pre-approval to get into it. I do strategy sessions all the time with clients, because whether it's in 3 months, 6 months, a year, you need to understand where you're going. And that is why, we'll have a strategy session, get into your preferences, discuss what you desire, and see if that matches up with your financial, statements and things of that nature. Going from there, and like I said, this is a very minimized approach. I have a full buyer's guide that I can send any of you if you want to get the full idea, but for the sake of time, we're just going to go through it here quickly. Obviously, once you have everything set in motion, you have your pre-approval in place, you can start touring properties. one mistake that I see people do is they start to tour properties before they get that pre-approval. For myself, I do not operate like that within my business. It can cause a lot of damage to the buyer, especially. People get emotionally connected, they fall in love with the home. It's a very emotional experience for some people that have been through it a couple times. You're competing with people. It's your place of safety and refuge. So when you start viewing things that you can't necessarily afford, a lot of time people can start having a little bit of buyer's remorse and take themselves out of the game here. I'm just going to admit one more person here. And so when you start touring and you understand where you want to go, then, the decision time. Hey, we've seen these 3 properties. Which ones fall in line with, what meets your goals and needs? And then if it comes time to, move forward with an offer, then we put together, I have, all these spreadsheets. We have all this data, statistics, and then we see what we can do in the offer presentation sort of things to make sure that we can save you the most amount of money and get you that home, especially if it could be in a competitive multiple offer situation. So the negotiation point is very, very important, and it's not always money. Dates are very important. Move-in dates, completion dates. Sometimes that can be more important than the price, and there can be other things within the negotiation point of an offer. It's not just always money. There's a lot of other things within the table. Are you buying furniture? Things about all this other sort of stuff. I'm not going to get into it, but like I said, it's not always just the money. There's a broad spectrum of things when it comes to negotiating a contract, and anything is negotiable. But yeah, anything when you offer on a property, you can write in anything that you want. If there's the garden gnome in the front driveway that you like, you can write it into the contract. The CPS, the contract purchase of sale, it's a lengthy document. There's lots of clauses, but all of that we go through in a step-by-step basis so that you're comfortable making that big decision. And then obviously once it comes time, if you get an accepted offer, I always say that you're about 60% of the way through, because now in this day and age, there's no more, unconditional offers. There's still a three-day buyer's rescission period now that the province put into place earlier this year. So even if you make an unconditional offer, which means, you sign the document, you have no conditions that need to be met, you still have 3 days to bow out for whatever reason. I'll go into that a little bit further. There is a penalty to that. But for most people, and especially in the market right now where it's a little bit slower, you will have some conditions. So subject to financing, making sure that once you get an accepted offer, you talk to Nick, you make sure that, the mortgage, the home appraises out. Is what sometimes people don't understand is that just because, say, you are, you can afford a home that's up to $800,000, and you're competing on an apartment that's 600, and you say, hey, this is the home for me. We'll go into my limit at 800K. Okay, great, you have an approved, an accepted offer. But when Nick sends out his appraiser and the home is appraised at, say, 700,000, your deal can die. So that's something that needs to be thought of too. Just because you have the means doesn't mean it makes sense, right? So due diligence, subject conditions, so subject to financing is very important. Even talking to Sina, your financial planner, if all of a sudden you have a bunch of investments that you need for your deposit, you got to make sure that you can pull that out. Sometimes, things can be locked away, or there's a vesting period or maybe a penalty. So even before we get onto that, talking to all your financial partners are so important, because how it works is usually you have, 10 days once you have an accepted offer to do all your due diligence. And if all of a sudden your deposit is usually paid 24 hours after the conditions are met, if you're banking on a bunch of money that is in your investments, and you can't have access to that, then you're going to be in breach of contract. So that's very, very important. Some people don't think of that. They haven't saved enough, because usually deposit is 5%. So on $1 million, that's $50,000. So if you don't have that cash on hand, you got to make sure that you have that. So quickly, subject to financing is very common. Subject to an inspection, making sure you get an inspector out, do due diligence of the home, make sure that everything falls in line. If there's major issues, you either back out of the deal, or you can renegotiate on the price point. But what's nice about a market right now, you are in a lot of control. There's not a lot of competition right now, so you can have a whole bunch of conditions that are there to protect you. So say, subject to financing, subject to inspection, subject to property insurance, things of that nature. If any one of those things doesn't work for you, you're out of the deal, you get your money back, there's no problem. So you have a lot of protection. Something that we're even seeing right now is the subject to sale, where, obviously it can be very stressful having to buy and sell, where a subject to sale clause would be something as in, hey, we want to buy this, but we have a time limit of when we can sell, and it gives you the best option where you can guarantee a sale of your home and you get the home that you want. So there's a lot of things within that. Once you get that accepted offer and everything goes through, you go into the closing side of things. So that's where you would be working with your lawyer or your notary. They're the ones that conduct, exchange the money. And usually how it works is if you get an accepted offer, it's usually about 60 to 90 days before you get a close. The closing date comes first. That's where the money exchanges hands and will go from buyer to seller. The lender will, with their instructions, change the money over to the buyer to make sure it can go to the seller. And then there's an adjustment and possession date. That's usually a day or 2 days after the completion date, and that is when you actually get the keys to your home. And one tip that some people overlook: when you have your closing date, say it's April 14th, that is when you own the property. You also need your home insurance on that closing date because you own that money when it transfers to land titles. Even if your possession date is the next day on the 15th, if all of a sudden there's like a fire or something on that completion date, that's your asset. So some people overlook that, and that's why, going back to it, there's a lot of realtors, you got to make sure that everyone knows every single part of those deals and those intricacies to make sure that you're well protected in all of those items. So once there's a closing, completion, and possession, that's when you can celebrate and move into your home. The cooling off period, like I said, this is only if you're going to do an unconditional offer. So you have 3 business days to back out of a deal for whatever reason. It doesn't include a stat, and it doesn't include weekends. So you can actually, with anything, there's loopholes and ways to weaponize it. You can actually weaponize your cooling off period into a mini subject removal period if you needed more time to do due diligence, and turn it into 6 days. If you put the offer in on a Friday and there's a holiday Monday, you can push it. But what it is you can pull out anytime, and the fee is 0.25% of the purchase price or accepted offer price. So you can see the example right here. So on a $400,000 home, it's $250 for every 100,000. So you would have a total fee of $1,000. So it's very small. When this was brought in, the province has made a lot of changes to our industry. People weaponize this too. Like, I thought that this should be much higher, 10%. For people that are higher net worth individuals, this is a very low amount of money. And I've been in deals where we have an accepted offer, they went above asking, and then right before the rescission date, they say, hey, you want to knock down 100K? Or we're going to rescind the deal, and they don't care if they're paying, some of these payments, and they use that as a weapon to try to do those things. So, I don't think it was that well thought out, but there is something for you to make sure that you're protected if you're doing an unconditional offer. Okay. So the next one here, transaction costs, what to expect. So number one, as a buyer, you do not pay a buyer commission to your buyer's agent. All the funds come from a seller's agent, and the selling side pays everything to the buy side and the sell side. Things for you to keep in mind with these key costs: home inspection, depending on the size of the home, anywhere from $500 to $1,500 if you're going to the detached route. Appraisal on the lending side of things can be around $200 to $500. You need your lawyer and notary to do all the appropriate paperwork. And that can be anywhere from $1,000 to $1,800, depending on your file. Moving down here, I'm just going to highlight some of the big ones. Property transfer tax. And this is the reason why this is important, is that you need this money in cash. You can't roll that into your mortgage. So with that being said, you can see that 1% in the first 200,000, 2% up to 2 million, 3% above 2 million. So those are items to keep in mind too during your financial plan, that you have money set aside for that in cash at time of closing. This is different than your deposit. This is something completely different. Your deposit makes part of your offer price, but this is something that can't be rolled into your mortgage. If you're going for pre-sale, I know that you had some pre-sale questions. Anything that's new construction, there's 5% on that. as well as if you're buying a home that's been substantially renovated, more than 90 to 95% of that home, that can qualify as GST as well, and you can pay 5% on that. So on the pre-sale side or assignment, if someone's selling a contract of a pre-sale, which is an assignment, those come up with 5%, and then it's up to the agents if they want to negotiate that out, but it's pretty standard practice. Even for an assignment, that 5% is to be paid. Sometimes a new developer, if they're trying to close out some units in a development, they'll waive or they'll pay the fee for you, but that's something to keep in mind. On the bottom here, we have a little example. Property transfer tax on a property that's $1 million would equal $36,000. So that is something to keep in mind depending on the price points that you're looking at. Special taxes, we went over the rescission period. Foreign buyers tax, there is an extra 20% for those who are foreign entities. We do have a foreign buyer ban for another year, but there are some workarounds depending if you're a student or have a work permit and things of that nature as well. And then also some incentives for first-time home buyers. If you are purchasing under $500,000, the PTT is exempt, and for new construction up to $750,000. So there's another hack. When I went to buy one of my rental condos, it was listed at $755,000. We did something where we did like a painter's allowance where I was able to pay cash for like $5,100 to drop my purchase price to $749, and then I didn't have to pay PTT. So there's always little things that you can do that can save a ton of money, because you can think, the savings on something like that. There's always little things that you can do within a contract to make sure you're just saving as much money as possible. Market conditions. So when people say seller's market, buyer's market, what does that mean? So essentially there's an equation where they divide the sales by what's active, and they use it as a percentage point. So for every, say, between 12 and 20 homes that are sold out of 100, that's a 12 to 20%. That's a balanced market. That's a really good area to be in. It's pretty fair for both sides. When we're above 20%, that's considered a hot market, and that's where we've been in for, since COVID has passed. We've been in a very high seller market conditions in around the Lower Mainland. Not so much the Fraser Valley, but the Greater Vancouver Board for sure. Anything that is below that 12%, as a buyer, that's where you want to take notice. That's where you want to start looking around. I use some advanced stats that really break down price points and these areas. So depending on what you're looking at, some of the advanced stats that I use, you can really look at where some of these buyer market conditions are. And as a buyer, that's where you want to jump in. Why is property getting so expensive? Who can afford property? Should you wait to buy? What should you do? I know most of the people in this room haven't purchased yet. So these are some data. This is some data that's come out from the CMHC, which is the Canadian Housing Mortgage Corporation, right? Yeah, Mortgage Corporation. So they're the ones that provide the mortgage insurance if you're doing less than 20%. For the most part, they've been super bearish of the market. They've called for market crash multiple times for years and years, like up to 40%, 50%, warning people not to buy, and it's done the complete opposite. So this was surprising that they put out this report to essentially show the problem that we are in Canada. So by 2030, and this is on the short end, they are showing that we're going to be at a minimum 4 million homes short across the country. So obviously with basic supply and demand, if we cannot build enough for the people that are coming here, the pricing is going to always remain high, and that is why Vancouver has the price points have stayed so high, is because of the lack of inventory, and we don't build enough to be able to get to those points. So we're a couple years now into the reporting now. We're in 2023, but this is where we are headed. And as we go here, we now project the discounted mortgage rate will be slightly higher at 5.6% in 2030. But essentially what the problem is here is, and answering the question, not a problem, but who is coming here? Why are they coming there? Why do we need them? So for those of you that don't know, 2.1 is the replacement rate for child bearing in any country. Does anyone have any idea what the 2023 number for Canada is?
Definitely less than 2.
Anyone want to throw out a guess at 1.33? So hugely problematic. So a lot of people throw so much shade on immigration. We actually need them so badly, because if we can't fulfill jobs within this country, our GDP is going to crash. We need workers. We need people to come here in these major centers. So we rely on it so largely, and we need to continue on these large numbers. So last year, any idea how many people came to Canada? Just under 1.1. Yeah, 1.044 million. So 400 and something thousand was through immigration, and then the bulk of them were non-residents. It's like international students, temporary workers. But all those people can afford, or those people can purchase. And Canada does a really good job in terms of attracting high net worth immigrants. So they rank number 6 in the world in immigrants that have a net worth of 7 figures or more. So obviously, if you're coming in with that, you're going to be able to get into the market right away. Vancouver BC has a population of just over 5 million. They let in 61,000 new immigrants to BC, and we hold the highest amount of international students, over 160,000. And for those who go to UBC, they drive, the G-Wagons, the Ferraris, Lamborghinis. They can buy homes, right? So of those, that's like 5%. I mean, I know I have done like listing videos, and a couple of these guys, they roll up, they have $800,000 worth of cars. They're 21 years old and they go to UBC, right? So they have the means to do it. So we had the most amount of immigration that came in last year, and Canada needs to continue that, if not increase it even more. So of these population projections, they could be even short, because CMHC was pretty conservative on their growth. So what does that, entirely mean? Obviously, Alberta, Ontario, within that have some of the lower numbers with some of these, the population changes. But what we're going to go into is some of the numbers and how this will reflect pricing. So like I said here, 44 million people in Canada by 2030, which represents immigration levels of around 600 to 700,000. And that's the immigration, that's so that doesn't include students or temporary workers. So that could far exceed that $1.2 million evaluation. So this is something that is really interesting to look at. So this is what the CMHC have predicted. Starting in 2019, their price predictions by 2030, and how does this relate to you as home buyers? Knowing the numbers of immigration, knowing what your competition is, knowing what rates are likely to do next year, starting to come down, British Columbia at a baseline will see a 76% increase over the next up until 2030 from 2019. Best case scenario, 90%, so a doubling. Keep in mind, this is all of British Columbia, so that is small town, things of that nature. So if we look at the lower mainland, Fraser Valley, high population areas, places where people want to live, these numbers are going to be far higher, well more than doubling. You can see across the country too, Quebec is very, very high, a doubling as well. Alberta, they had some of the more lower numbers there in terms of their asset classes. But in BC, when you see these numbers, what people are doing, coming here, moving in here. You can see right here what some of the increase in price points can do. It's very, very overwhelming, especially if you're not in the marketplace. It can be, feel very hopeless. And that's why I speak so much about mindset. That's why I speak about strategy sessions. Foundation piece number 1, Sina, financial planner, making sure that you know where you're going to go. Number 2, you talk to Nick, right? Get all this in order. Maybe you're ready to go. Maybe there's some tips that he has for you to move forward. Then you get in touch with me and we hit it out of the park, and then we can start growing, your real estate portfolio. But I know, and I'm always careful talking about this, because some people make it seem, oh, it's so easy to get in the market. It's not. It's very hard. You got to work hard, but you need to have that mindset and you need to have that plan. So that was Canada-wide. How is the market right now? What are you guys hearing on the ground? I've had a couple calls this week. People say, no, it's not a great time to sell. The market's not that great right now. What are you guys hearing being in the marketplace? Buyer's market.
I heard that it's going to go down next year.
Go down. So not a great, like right now, pricing is probably pretty soft, things of that nature. So that, a lot of people conduct and get their media or their information from the media who, is putting it through a story. So let's go and look at 3 different models here. So these are apartments. The green line is the Greater Vancouver board, so Sunshine Coast all the way to Coquitlam. Because we're in Vancouver, I put it into Vancouver West in blue, Vancouver East in orange. This is the last 10 years. So what can you see here with the price points? we're pretty much at all-time highs across the board in the apartment category. So a lot of people saying, oh, it's not a great time to buy. Is it going to be soft? If you look at this, we've seen a little bit of a dip here. And what I've always said, look at how high the rates are and look what pricing has done. And people, you know, there's flip back as well, what about these mortgage renewals and things of that nature? Well, you know, there's still not a lot of inventory. Even if all this stuff came to market, we still need that product. So what we're likely going to see, and you can kind of see every time there's been a little bit of a down correction, it pauses and goes up. We're, I think, in a melting point here where we've already seen this downward little trend. We've had, several months of pricing increasing through 20-year high interest rates. So when things start going down, I do predict, there is going to be a frenzy at some point next year, probably not this spring, but maybe by next September. Case in point, right now, yes, pricing is still high. Yes, rates are still high, but you're in complete control of the process. You can have your conditions, you can do all that sort of stuff to protect yourself, and you can, get a 2-year or 3-year fix, wait till things go down, refinance, because what would you rather have? A couple months where or not a couple months, maybe 24 to 36 months of a higher payment, maybe you budget, you don't go out to dinner as much because this is a long-term plan, or the alternative is wait, where the rates come down and now you're going to have to pay maybe $100,000, $150,000, depending what you're looking at, over asking, being pressured in the situation, and you're going to come up way ahead, and then that extra $150,000 is going to be financed as well. So these are apartment numbers. The next one here, these ones here are townhouses. Same sort of story, a little bit of a deeper drop down. They've really resounded or responded very, very well. And you can see townhouses right now in the blue are all-time highs in price points. And these ones are very, very close to what they were as well in 2022. And then finally, the detached market, a little bit more of a slower roll in terms of Vancouver West. Obviously, the average price point in Vancouver West is $3.5 million. 3.48. But these other ones here, no matter what category you're looking at, you're pretty much at all-time highs. So what I'm trying to say is the longer that you wait for whatever it is, the more money you're going to be paying, the more money you're going to pay in lending. People, unless you're making, $400,000 or $500K annually, you can't save as much. And the more that you wait, you could completely price yourself out of where you want to live. So this is not to pressure anyone. All this is based off data and where things are going. We have an outlook here of what's happened the last 10 years. We've had an immigration report of what's going to happen up until 2030, and it doesn't look good. So what I suggest for anyone getting into the market or wanting to leverage, have those conversations now. Obviously, I'm hoping it's with me and with my friend Nick and Sina and these people, because now is a really good time. The winter months for a buyer are the best months to get into the market. It's soft. Usually people that are listing now, there's a reason why: financial hardship, divorce, death. And a lot of people are waiting, it's Christmas, it's New Year's. So I've had a lot of great success getting people into the market in December and January because people are sleeping. Less inventory for sure, but usually if you're a first-time home buyer, this is not going to be your forever home, so who cares? Get in, and maybe it's 2 or 3 moves until you get your forever home, but the point is just get in now. You can see the benefits of it, and that's all that I got for you here. And I think we're going to have Sina wrap things up with how you can protect that asset here as well. Any questions that anyone has in the chat or here in person? I know with all of us, there's just so much information, it can be overload. So I have a buyer's guide that I can send anyone that's electronic, or if anyone has the questions about the market or the process, feel free to let them out right now.
Can you pull up the page with the QR codes, please?
Nadisha, QR codes. On average, how long is the entire home buying process? If you have done the due diligence, you've got your financial planner in step with you, your mortgage broker in step with you, you know exactly what you want. You've had enough conversations with me, so I am sending you stuff that you should theoretically be offering on every week. It can happen quite quickly. If, you're maybe something more niche, a higher end property, those always take longer. But for people that are just getting into the market, and it's not their forever home, they don't have a lot of different specific things. I get people in sometimes the first weekend done. A lot of people in the first couple of weeks, but we've done a lot of work to get to that point. Anyone else? Good. Awesome.
Okay. Thank you.
All right, guys. So I want to pay attention to time as well. I want to finish it off. But here's what I'm going to talk about. I always like the idea of taking a couple steps back because we just spend around an hour and a half going through information. So let's take a couple steps back. What's the point of all of this? See, for me, I studied mechanical engineering, right? Saying that to say, I didn't really have the opportunity to get any sort of financial information at high school, at college, at university. But I like the idea of making good decisions with my money. And it seemed like, and it also seems like, buying your first house is a good decision. So as soon as I started making money, I'm like, you know what? I should probably prepare to buy my first house. But there was a lot of missing gap. There's a lot of gaps. There's a lot of missing information. So my idea was, you know what? I'm gonna go to the bank because that's where people go to learn about money. So I went into my bank and I had a meeting with an advisor. But what's interesting is it seemed like it seemed like the conversation was happening here. But I'm here. There's all of these things that I want to know in between, and all of this is being ignored with my conversation with the individual at the bank. So it ended up being a very confusing conversation for me. And my idea was, I want to take a couple steps back. I know you know what you're talking about, it seems like, but there's so many things in between that I need to figure out first. One of those things was, if I'm planning to buy a house and I'm saving for my down payments, how am I going to keep up with inflation with my savings? Because if I can afford to buy a house 6 years from now, over the next 6 years, my money is going to lose value. What's going to happen there? The other question was, how am I going to pay attention to my taxes? Right? How am I going to make sure that I keep my taxes in my own pockets and put it towards buying my first house? The other question was, how am I going to protect my worst case scenario? I'm assuming I'm going to make money going forward, but what if that assumption is wrong? What if I lose my income for 2 months? Or 8 months? Or a year? Or 2 years? Who's going to pay my mortgage? So there's all of these things on my mind as I'm trying to kind of like learn how to make good decisions. And what's interesting is, it was only through a conversation with an independent advisor that my thirst for information was satisfied. And this conversation was 2018. What is that? Like 5.5, 6 years ago. And what I realized is, see, as an engineer, they teach you to be a problem solver. And what I found was, the problem that exists in this country that is worth solving the most is the problem of financial education and financial literacy and financial understanding and financial decision making. It's a much more interesting problem to solve in comparison to any mechanical engineering problem. So that was the beginning for me to kind of like get curious and step into the industry and go through the licenses and all the qualifications and be able to do what I do. And saying all of this to say this, see, there's a lot of different things that we have to pay attention to when it comes down to decision making financially. The whole point of this entire thing is to get to a point in your financial life where you don't necessarily have to worry about money ever again. That's the ultimate goal of all of these informational conversations and all of that. And you always want to, surround yourself by the right people that give you the right advice in order to get there. And in order to get there, there are a couple of different things you need to pay attention to. And here's why. Buying your first house is a very interesting and important part of your financial journey in Canada. See, there's a couple of different ways that you can actually grow your wealth in a tax-free way. There's only a couple, 2. One is through your tax-free savings account, where you can invest up to a certain limit and then grow your money tax-free and have access to it tax-free. The other one is any sort of capital gains you have on your principal residence, on the home that you live in. So that means you buy a home with the help of Nick and Kyle for $1 million, you sell it for $20 million, you grew your asset by 19 million. But it's your first house, tax-free. So it's an important thing to pay attention to in the big picture of your financial life. Now, hopefully today's session gave you guys an idea of the different tools that you can use, and how you can contact me, Kyle and Nick, to go through all of this. My style of doing things is I always take a couple steps back. I always make sure that as far as foundational information, we're on the same page. As many times as it takes, I typically take 3 different time slots to go over the basics of financial planning and financial kind of decision making, things that I believe should have been taught to me in high school or college anyways. And once we go through all of that, then it becomes fun to sit down and talk about planning and buying a house and everything else. You guys can find me on Instagram, LinkedIn, my QR code. Well, I was hoping that it's on here, but it apparently wasn't. You guys can find Kyle on Instagram, on LinkedIn, same with Nick. And we would be able to help you guys with so much more information, and hopefully you found this interesting. And it was a pleasure having this meeting with you guys over the past hour and a half. Thank you guys for joining us, and we will see you guys in another day.